October 24th, 1929, Black, Thursday, the day the music stopped. September 15th, 2008, Lehman Brothers falls. The world holds its breath. And now, 2025. The patterns are repeating. The warning signs are flashing red. History doesn't repeat itself, but it rhymes. And right now, that rhyme is becoming deafening. What if I told you that every major financial collapse follows the same playbook? The same psychological traps, the same institutional failures, the same human delusions. Today, we're going to decode the pattern. We're going to see what 1929 and 2008 can tell us about right now. And by the end of this video, you'll understand something most people refuse to see. The crash is never the problem. It's the come down from the high. Picture America in 1929. The world has just survived the Great War. Technology is exploding. Radio, automobiles, aviation. Electricity transforming cities overnight. The stock market isn't just rising, it's flying. Between 1924 and 1929, the Dow Jones increases by 400%. 400% in 5 years. Fortunes are made in weeks. Shoeshine boys are giving stock tips. Everyone's getting rich. But here's what's really happening beneath the surface. Margin trading. People are borrowing 90 cents for every 10 cents they invest. The entire market is built on borrowed money, borrowed dreams, borrowed time. Banks are making speculative bets with depositors' money. There's no separation between commercial and investment banking. No Federal Deposit Insurance Corporation. No safety net. And the wealth? It's concentrating at the top. By 1929, the richest 1% of Americans own 40% of the nation's wealth. Sound familiar? Meanwhile, agriculture is collapsing. Farmers are drowning in debt. The real economy, the one that feeds people, makes things, creates actual value, it's been struggling for years. But Wall Street doesn't care. Wall Street is having a party. And then comes a psychological trap that destroys empires. This time is different. New era thinking. That's what they called it. The old rules don't apply anymore. Valuations don't matter. Fundamentals are outdated thinking. The market will keep rising forever because of progress. Because technology. Because America. Thursday, October 24th, 1929. Panic selling begins. 12.9 million shares trade hands. The ticker can't keep up. By the time prices are reported, they're already outdated. Terror spreads like wildfire. Black Tuesday follows. October 29th. 16 million shares traded. Fortunes evaporate. Life savings disappear. Margin calls cascade through the system like dominoes. But here's what most people miss about the 1929 crash. It wasn't the crash that destroyed America. It was what came after. The Great Depression lasted 10 years. Unemployment hit 25%. Industrial production fell by 47%. 9,000 banks failed. Millions lost their homes. Bread lines stretched for blocks. Why did it last so long? Because the response was wrong. The Federal Reserve contracted the money supply when it should have expanded it. President Hoover raised taxes and tried to balance the budget during a collapse. The government let the banking system implode. Policy failures turned a crash into a catastrophe. Remember that. Fast forward, 2004. America is riding high again. The dot-com crash is in the rearview mirror. Interest rates are at historic lows. And Wall Street has found a new gold mine. Housing, homeownership, the American dream. And now, it's easier than ever to achieve. No money down, no income verification, no problem. They called them ninja loans. No income, no job, no assets. Sign here. But this time, there's a new innovation. A financial weapon of mass destruction, though nobody calls it that yet. Securitization. Here's how it worked. Banks make thousands of mortgages. Then they bundle them together into securities called mortgage-backed bonds. Then they slice those bonds into different risk levels tranches. Then they sell them to investors worldwide. And here's the genius part. The banks don't keep the risk. They pass it on. They originate the loan, collect the fees, and sell the risk to someone else. What could go wrong? Everything. When you remove consequences from decisions, behavior becomes reckless. Underwriting standards collapse. Appraisers inflate values. Rating agencies, the gatekeepers who are supposed to protect investors, they're paid by the banks creating these securities. Conflict of interest? Absolutely. But nobody's asking questions because everyone's making money. And then comes the leverage. Investment banks are borrowing $30, $40, even $50 for every dollar they own. Bear Stearns, Lehman Brothers, Merrill Lynch. These institutions are ticking time bombs wrapped in Armani suits. Meanwhile, something even more dangerous is brewing in the shadows. Credit default swaps, insurance policies on bonds. Except they're not regulated like insurance. Anyone can buy them. You don't even need to own the underlying bond. It's like buying fire insurance on your neighbor's house, then betting on it burning down. AIG sells hundreds of billions of dollars worth of these swaps. They collect premiums. They book profits. But they never expect to pay out. They haven't set aside nearly enough reserves. By 2006, the cracks start showing. Housing prices stop rising. Foreclosures begin climbing. But Wall Street keeps dancing because the music hasn't stopped yet. Summer 2007, two Bear Stearns hedge funds collapse. They were loaded with subprime mortgages. August 2007, a French bank freezes withdrawals. We can't value these assets, they admit. January 2008, Bank of America buys Countrywide Financial in a fire sale. March 2008, Bear Stearns implodes over a weekend. JP Morgan buys them for $2 a share. The government backs $29 billion in losses. The dominoes are falling. September 15th, 2008. Lehman Brothers, 158 years old, $600 billion in assets, files for bankruptcy. The largest bankruptcy in American history. The credit markets freeze. Banks stop lending to each other, to businesses, to anyone. The entire financial system seizes up like an engine without oil. The stock market crashes. The Dow falls 777 points in a single day. Retirement accounts vanish. Unemployment skyrockets. The global economy teeters on the edge of another Great Depression. But this time, the response is different. The Federal Reserve opens the floodgates. They cut interest rates to zero. They create trillions in new money. They buy up toxic assets. The government bails out banks, automakers, insurance companies. It's ugly. It's unfair. But it works. Sort of. We avoid another Great Depression. But we don't avoid the pain. 9 million Americans lose their jobs. 10 million lose their homes. Household wealth drops by $16 trillion. A generation loses faith in the system. And the people responsible, most walk away wealthy. Too big to fail becomes too big to jail. The lesson of 2008 wasn't learned. It was buried under bailouts and quarterly earnings reports. Let's step back. Two crashes, separated by 79 years. Different technologies, different financial instruments. But look closer. The pattern is identical. Both periods follow major disruptions. The 1,920 seconds came after World War I and a pandemic. The 2000s followed the dot-com crash in 9/11. In both cases, policymakers flood the system with easy money to promote recovery. Low interest rates, cheap credit. Money becomes too easy to borrow. Stage 2, the innovation. In the 1,920 seconds, it was margin trading and holding companies. In the 2000s, it was securitization and derivatives. New financial instruments that seem brilliant. That promised to distribute risk, increase liquidity, democratize wealth. But in reality, they hide risk. They increase leverage. They make the system more fragile. Complexity becomes a feature, not a bug. Because if nobody understands it, nobody can question it. Asset prices detach from reality. In 1929, stocks. In 2008, houses. Speculation replaces investment. In 1929, stocks. In 2008, houses. And everyone has an explanation for why it's sustainable. New era thinking, housing prices never fall nationally in the 2000s. The fraud begins. Small at first, then systematic. Bernie Madoff, Countrywide Financial, massive lending fraud, accounting tricks, rating agency corruption. When everyone's getting rich, nobody asks hard questions. The smart money starts getting nervous. A few voices in the wilderness warn about overvaluation, leverage, systemic risk. They're ignored, mocked, called pessimists and dinosaurs. In 1929, some bankers quietly sold their positions. In 2008, a handful of hedge funds bet against the housing market. The insiders know. They always know. But the music is still playing, and nobody wants to leave the party early. It's never what people expect. Not some massive, obvious catastrophe. It's a small crack in the foundation. In 1929, a mix of overvaluation and the Smoot-Hawley tariff debates. In 2008, 2 hedge funds and a French bank, confidence evaporates, liquidity disappears, leverage becomes a death sentence. The scramble for cash begins. Fire sales, margin calls, cascading failures. Panic feeds panic, selling begets selling. The herd stampedes for the exit, but the exit is too small. Values that took years to build disappear in days. Institutions that seemed eternal collapse overnight. Here's where the 2 crashes diverged. 1929 led to policy paralysis and a decade of depression. 2008 led to massive intervention and a slower, unequal recovery. But both left scars, both created political upheaval, both shattered the myth that the system was stable and fair. So the question is obvious, isn't it? Where are we now in the pattern? Look around. 2025. We've just emerged from a pandemic. Sound familiar? Followed by unprecedented monetary stimulus. The Federal Reserve printed more money in 2020 to 2021 than in the previous century combined. Interest rates were at 0 for years. Now, they've risen sharply, the fastest tightening cycle in 4 decades. Debt, government, corporate, consumer is at all-time highs. And what did we do with all that cheap money? We created new assets, new innovations, new manias, cryptocurrencies, NFTs, meme stocks, SPACs, private equity levering up companies, venture capital burning billions on unprofitable tech companies. Disruption became a substitute for business model. Real estate has soared again. In many markets, prices exceed 2008 peaks. But this time, it's not subprime mortgages. It's institutional investors buying tens of thousands of homes, private equity rolling up entire neighborhoods, short-term rental arbitrage. The wealth gap has widened. The top 1% now own more wealth than the entire middle class. The system isn't creating opportunity, it's extracting it. And the stock market? It's been on a tear. Tech valuations that would make the 1,920 seconds blush. Companies worth billions that have never made a profit. AI hype cycles reminiscent of the dot-com boom. But here's what should terrify you. The leverage, the interconnection, the complexity. Shadow banking, non-bank financial institutions managing trillions in assets outside traditional regulation. Algorithmic trading making split-second decisions that can crash markets before humans can react. Global supply chains so intertwined that a single point of failure can cascade worldwide. The system is more complex, more leveraged, more fragile than ever before. And once again, we're hearing that phrase. The most dangerous phrase in finance. This time is different. Different because of technology, because of artificial intelligence, because of innovation. But is it? Or are we just in stage 3 of the pattern again, the mania phase, where prices have detached from fundamentals, but everyone has a rationalization? Are we ignoring the warning signs? The commercial real estate crisis, the regional banking stress we saw in 2023, the mounting defaults in corporate debt, the geopolitical instability, the climate risks that aren't priced into any assets. The smart money is already moving. Warren Buffett's sitting on record cash. Insider selling is at historic levels. Certain hedge funds are building massive short positions. They know something. So what's the trigger this time? What's the crack in the foundation? Maybe it's interest rates staying higher longer than the market expects. Maybe it's a wave of corporate bankruptcies from all that cheap debt coming due at higher rates. Maybe it's a geopolitical shock. a cyber attack on financial infrastructure, a climate catastrophe that finally makes the uninsurable obvious. Or maybe it's something nobody's even thinking about yet. It always is. The pattern tells us the crash is coming. It can't tell us when or exactly how, but it can tell us to be ready. Here's what you need to understand. Crashes aren't accidents. They're not acts of God. They're the inevitable consequence of human psychology meeting flawed systems. Greed, fear, herd mentality, recency bias, the belief that what just happened will keep happening forever. These don't change. They're hardwired into us. And the system is designed to privatize gains and socialize losses, to reward risk-taking until it fails, then bail out the risk-takers with public money. After 1929, we built safeguards, bank deposit insurance, securities regulation, the separation of commercial and investment banking, social safety nets. After 2008, we built some regulations. Dodd-Frank, stress tests. But much of it has been watered down or repealed. Too big to fail, banks are now bigger than ever. The shadow banking system is larger and less transparent. We didn't fix the system. We just inflated the next bubble. So what do? You can't time the market. Nobody can. Anyone who tells you they know when the crash is coming is either lying or delusional. But you can prepare. You can be anti-fragile, reduce leverage, build cash reserves, diversify not just across assets, but across systems. Invest in skills, relationships, resilience. Understand that the safest looking investments, the ones everyone agrees on, the consensus trades, those are often the most dangerous. And politically, demand better. Demand accountability. Demand a system that doesn't require taxpayer bailouts every decade. Demand leaders who will rebuild safeguards instead of dismantling them. The pattern tells us crashes are cyclical, but it also tells us recovery is possible. After 1929, we built the strongest middle class in history. After 2008, we rebuilt, however imperfectly. We survive, we adapt, we learn. Sometimes. The question for 2025 isn't if the pattern will repeat. Patterns always repeat. Human nature doesn't change. The question is whether we'll recognize it soon enough, whether we'll respond wisely enough, whether this time, finally, we'll build something more resilient. The clock is ticking. The warning signs are flashing. History is trying to tell us something. Are we listening? If this video made you think differently about where we are right now, hit that subscribe button. Share this with someone who needs to see it. And in the comments, tell me, do you think we're headed for another crash? Or is this time actually different? Let's talk about it. Until next time, stay aware, stay prepared, and remember, the pattern always rhymes.